Hi, thank you for joining the podcast. I'm David Liao, co-CEO for Asia and Middle East for HSBC, and I'm super excited to have Cathie Wood, CEO and CIO for Ark Invest, to join us today.
My great pleasure. I'm very happy to be here with you, David.
Thank you. Cathie, tell us about the story that, of how the whole Ark came to be and the thesis, and we can perhaps expand into the current affairs.
Sure. Actually in 2012, I knew that I needed to do something to at least do my little part to help transform our industry. And when I say that, that sounds like a very large task, and it is, and will impact it only so much. But what had happened in the previous years is especially tech and telecom bust, and then even more so after 08, 09, I watched our markets going passive because a lot of people were just scared of equities, didn't want to take any risk, and felt that a passive strategy, just broad-based benchmarks, would work fine for their asset allocation. And at the same time, I was looking at 5 major technology platforms that were evolving at the same time that we believe are going to transform the world completely. And what does that mean? It means that the traditional world order, as represented by broad-based benchmarks, could change dramatically. Now, I know many companies in those benchmarks will adapt, but others won't. And I felt there was an unmet need out there for a diversified exposure to innovation based on research that very few people are doing out there. And the reason the research, I think, has lessened over time is the move to passive. Yeah. And so I felt we could contribute that way, and then also contribute by introducing new technologies into our business.
How do you feel about, perhaps the passive investing may not have been the best way to allocate resources? So you use an analogy of, rather than using a shotgun approach, you use a rifle approach to really stake into the growth.
Yes.
How does the fund manage, differentiate, balance that? It certainly could bring volatility. It certainly can bring a lot of excitement. So how do you bridge that into an investor proposition?
Yes. Well, the very first thing is we have a 5-year investment time horizon. We're not investing for this quarter or next quarter. We're investing for the next 5 years because we believe these technologies they're ready for prime time. Almost all of them are ready for prime time. So we talk about robotics, energy storage, artificial intelligence, talk about ready for prime time, but very early, blockchain technology and multi-omic sequencing.
And is 5 year long enough or too short? Is it an investor timeline that you're catering to?
We've imposed it on ourselves because with this thought, that if the market is not going to start discounting the scaling of this new technology within 5 years, so the technology need not scale within the next 5 years, but if there's a new technology evolving, very early days, and we believe the market is going to start discounting the scaling. And we've just been in an environment where the market discounts nothing. It's only looking at this quarter.
Yes.
So it's been a very rough environment for innovation and our style of investing. And as you say, very volatile. But if we're right and these technologies are ready for prime time, I think the right thing to do is to basically, as we do with each of our investments, leg in gradually and let the quarter-to-quarter evidence dictate how much more rapidly we should move in. When I say quarter-to-quarter, we listen to all of the quarterly reports and we have callbacks with management, and we'll be asking them questions about, okay, what is either impeding the growth or what could accelerate the growth here? We're very focused on that. So 5-year investment time horizon, yes, there's volatility. I think there will be less volatility with time because these technologies are maturing.
We will definitely touch on the macro
Yes.
and some of the worldviews that
Yes,
you have
yes.
to form the thesis of the soil to
Yes.
grow innovation.
Yes.
I think as distinct as it is for the Ark Fund, would you also say that the mindset and the type of investors are also slightly different from some of the other passive funds or international funds? Because as you described, you're certainly not offering a fixed income product.
We are not.
You're not. And the texture of your investors seems to all kind of be quite resilient. They buy into this story. They do patiently sit for
Yes.
the long term. Would you feel they're different or? Yeah.
Yes, and I'll give you a sense why. Blockchain technology and cryptocurrencies talk about the Wild West, as we would say in the United States. I don't know if you would use the same
use
expression.
the Wild East.
The Wild East. Talk about the Wild East and West. Blockchain technology, hugely volatile. And yet anyone who's stuck with Bitcoin, for example, has been very happy. So they've been willing to put up with the volatility because they actually believe this technology will work. It's a technology, it's a new asset class, it's a monetary system. There are all kinds of reasons to own it, and people own it for different reasons, right? So that's been a very good training ground. Another one in our own case is Tesla. That has been a wild stock as well. But if we're right, first of all, the rewards have already been enormous. And yet, if we're right, they've just begun because the robotaxi movement has really just begun. And the humanoid robot movement has just begun. The part of the market that we're focused on is the most inefficiently priced part of the market. And so one of our core missions and values is education. Education of investors, of course, but also education, anyone who wants to read our research to understand how their lives, their children's lives, their grandchildren's lives are going to change because of technology. We want to offer that. And I think that also has added to our brand, that we're not just all about making money on these portfolios, but we really are very sincere in our effort to educate, and anyone who wants to read our research.
And that's really amazing because it almost feels so much more aligned as we run into innovation and new creation, and that's new. And so when things are new, people don't know where to put things, and that almost you're starting a conversation on how Ark or how Cathie looks at it, and then it's like, what do you think? And obviously they would think of a lot of things, and that really encourages the discovery of the value of these stocks.
They're participating in the discovery, and investors love that. They really do. They love being along for the ride and actually taking a point of view. We give our Tesla model away, and you can adjust the variables that we think are important if you think we're wrong, and then you'll have your own price target.
Your own model, yes.
And so we're happy to do that. And I think it's going to help over time increase the efficiency of the markets when it comes to innovation. Right now, we think they're very inefficient.
That resonates with a recent occurrence, and obviously that's DeepSeek, which came in rather small, but extremely transparent about their models, their research. Almost on day one, they democratized it. They laid it bare and open. For a while, I had people coming to me in the first 2-3 weeks and saying, we've built something just like DeepSeek, but better. And my response was, well, of course you would, because DeepSeek has offered to you to build upon it. And it's a truly open model. And it, almost it resonates in terms of how you present your case and democratize it and allow that to come through.
Absolutely. And now, you had in the United States, Jensen Huang, CEO of NVIDIA, Sam Altman, CEO of OpenAI, saying, wow, that was a breakthrough algorithmically. Maybe they didn't do it all together for $6 million, but that almost doesn't matter. There might have been a lot of pre-training, but what mattered was the algorithm, the creativity, which I think shocked a lot of people in the United States and disarmed them, and also brought back into this conversation the notion of open source. Now, we have done a study on open source versus closed models. And if you look at them, you'll find that the closed models are still the best. Okay. However, if you look at the performance, the slope of change of performance gains, open is moving faster. And the only really open model we had in the United States was Meta Platforms, Llama 3. And we thought the world was starting to close. And then here's DeepSeek saying, oh no, here's open source. And I think that's very healthy. I really do. I think both will coexist, for different reasons.
And different rhythms, and there are different times.
Exactly. And some models are better at one thing versus another. So that's fine. But, I learned about the open source movement way back with Linux and getting my head around that. And it was just like, no, that's a very good idea, because what is this? It is all these developers from around the world developing to this ecosystem.
I trust the fact that we're speaking in Hong Kong, you're voting with your feet.
Yes, indeed. Absolutely.
So it'd be good to touch on that before we move to Trump.
We're not here just because of the DeepSeek moment. We're here, because of HSBC, very importantly. You're blazing a trail. As a student of innovation and studying what is happening in China right now, we're astonished at what's happening from an innovation point of view. Before COVID, U.S. pharmaceuticals and biotech companies in-licensed 4% of their molecules from China. Or no, it was 5%. Now it's 44%.
44%.
44%. And some of the biggest breakthroughs we're seeing in what we're calling the multiomics revolution, which is DNA, RNA, proteins, so forth, are occurring in China. And, when I heard President Xi Jinping start using the phrase new productive forces, I began to think, okay, wait a minute. Is this the government basically saying, we want to encourage innovation. We want to be number one in innovation? Might be. When the government here puts out an objective, the entrepreneurial zeal of the people takes over and they accomplish incredible things. So we're very focused on innovation. And I'll give you an example of why China is so important in terms of progress in innovation. In the United States, of course, everyone knows Tesla. We talked about it earlier. And the prevailing wisdom when we picked up Tesla, we bought it practically when it went public, was that GM and Ford and Chrysler at the time had R&D budgets that ran circles around Tesla's sales. There was no way Tesla was going to break through. Right. Recently, GM and Ford have pulled away from EVs. Right. Why? Well, their shareholders didn't like that the EVs are not profitable. Well, guess what? They're not going to be profitable unless you scale them. That's just not possible. So when they pulled back, we said, our models, which are all based on units, unit growth dynamics, with increasing units, costs come down with new technologies. We're saying, well, Tesla can't do this all alone. And then we own BYD. And then we thought, China's going to help Tesla make this happen.
From your lens,
yes.
What's the soil in China? Does that nurture innovation, or do you feel it's a much more kind of
I think
US?
Oh, no. I think the DNA, the entrepreneurial DNA in China, and I noticed this in '94, And when really things were just getting going in many ways.
Yes,
Certainly in
yes.
Shanghai, there was just one skyscraper, right?
Yeah,
So, but back then, I just saw the entrepreneurial zeal right away. So there's something from a DNA point of view that
it's the people that you can't stop.
The people. You cannot stop them. Yeah. I will say that I think common prosperity was a phrase. So the government was trying to get sorted out more access and so forth into more of the population and at lower prices. And so that wasn't about innovation. But new productive forces is about innovation. And oh, by the way, I might say that technology does increase access because costs naturally come down.
Yes.
So it is fitting with common prosperity. It's just they weren't framing it that way.
Yes.
New productive forces is very clear directive from the government. Go for it.
So going back to the China-US relationship, you almost spoke of by necessity that this innovative forces and the impact on pricing is conducive to how US continues to grow by receiving imports of deflation.
Yes.
How would President Trump sort of manage that, harness that while posturing tariffs and all other policies?
I have been struck that President Trump has been much more forceful when it's come to Canada and Mexico than to China.
A bit surprised by that, yes.
I mean, we've been
Martin
very
Wolf
surprised.
was saying the same. Right?
Yes, we've been very surprised. Now, President Trump, he wants a strong economy and a strong market. And with Elon Musk by his side, I think that he's beginning to understand that we need the unit growth dynamics if we are going to, if innovation's going to flourish globally. Yeah. And the U.S. Has been leading in innovation over the years. I actually think China and U.S. will be doing this together. Now, maybe that's wishful thinking on my part, but we know that Elon Musk understands this. He's very dependent on China, right? And he's seen how important the unit dynamics in China have moved Tesla ahead.
Yes.
Right? And could we be in another Nixon in China moment? Could we be? Because people do trust Trump in terms of negotiating.
Yes. Wow.
And so, he'll drive hard negotiations, but that's the name of the game, try and get the best deal. Each side will vie for the best deal, and then you come to an understanding.
We talked a lot about China and the U.S. Innovation, creativity in the rest of the world. Where are you seeing? Where is catching your attention?
What I think is important about this moment is the cost of innovation is collapsing. The first stage of the collapse started with the cloud.
Yes. Right?
That democratized to a certain extent innovation. Now with AI training costs dropping 75% per year, AI inference costs dropping 85 to, thank you, DeepSeek, 95%
and accelerating,
per year.
Yes.
I think that innovation, I get the question from Europe all the time, what's wrong with us? Why can't we? And I always say, half the solution is understanding the problem. Why is this? Well, you don't have deep capital markets because you're not incentivizing in innovation. You are strangling innovation with regulation. And we're hearing a little bit about regulatory clarity or taking down some it'll take a long time because they have put in so many regulations, country by country, and now EU, that is going to take a while to work out. But
for
they're
them to
asking
bring
the
unity,
question.
yes, they're asking the right questions.
UK has pulled away from that. They may have a better shot.
Because one question I have is, on that basis, is the China model systematically sustainable? Because it's, even at the two meetings, they're concerned about the involution and not offering the right margin as a system to allow room for R&D, which may mean it gets expressed in perhaps the state, but it may get expressed in where behaviorally people spend, however transient that might be in pockets, and draw economics from that,
Yes.
perhaps to subsidize. How do you think?
So I think again, I place a lot of importance on any words that your leadership places importance on. Common prosperity.
Yes.
To us, the tagline there would have been, get your margins down, get these products and services out as far into the other provinces as you can. And that would be, commoditization, and would not leave a lot of room for R&D.
That's right.
I don't know, you'll know before I will, I'm sure, but if new productive forces is also a signal that, the profitability, the profit margin is a part of why innovation is going to sustain and why China will rise to be one of the top. I already think it is one of the top.
It is certainly
innovators.
a topic, actually.
Yes,
yeah,
yes.
So
if you want to build up this idea of innovation and healthy competition between China and the U.S., I think that would be a win-win.
and offers the margin for creativity, for R&D.
For R&D. It doesn't
And
even...
would that be inflationary?
Not at all,
No.
because technology is deflationary.
Okay, so it would well compensate by the ability to scale.
Yes. Technology is inherently deflationary.
Yeah.
And so you get the best of both worlds.
So it's the margin's almost the fuel, is the
It's
fuel and the promise.
fuel, and it's what they turn around and do with the margin.
Yes,
Yes.
yes.
Productivity increases are caused by all of these new technologies. You can turn it around in a number of ways. More R&D, but maybe not if you're forced to change it into lower prices. So, but more R&D, lower prices, higher margins. Or more compensation.
Yes.
So those are the four
That
uses.
is interesting.
Yes.
That's
yes.
big topic for China
It's a
as
big
well.
topic. Yes. Well, and that's a competitive advantage China has. Your compensation schemes here are so much lower. It does mean in the U.S., in order to compete with China, we have to get so much more productive, right?
Yes.
So much more productive
Yes.
that we can do what we're doing with fewer people.
Yes.
Because of the compensation differentials.
How do we resolve that? Did you, for China, where you have a systematically kind of suppressed sort of wages, almost, a large state part of the economy, what would be your sequential advice to resolve that?
Yeah. Again, I think if China is innovating as aggressively as we believe they are, it does seem to be the case. The productivity gains coming out of that are going to be enormous, especially if the U.S. is working on the same sorts of technologies. And if they can turn that productivity increase into more wage gains, that's a win-win from an economic point. Then you bring the consumer back.
Feeds into consumption, yes.
Yes, this economy, as I've analyzed the macros, still way too dependent on fixed investment relative to consumption.
Yes.
So I think we'll each use that productivity increase differently.
Last question,
Yes.
going back to where you felt, was where did the fear come from the U.S.? Why don't we explore the 37 trillion debt problem? How do you, how would technology and innovation solve that?
So this is really a throwback to the early days of my career with Ronald Reagan.
Right.
Ronald Reagan, because we had back-to-back recessions, he was jacking up defense spending. So the deficit went wild. We went to 5.5% of GDP. And this was the topic of the day. Today we're at nearly 8% of GDP. Not in a recession either, but in a recovery. So that's a real indictment of what has happened, not just the last 4 years, but many presidents. The way we got out of the Ronald Reagan deficit problem was growth. It was more through growth than cutting spending or increasing taxes. Increasing taxes doesn't work.
Yes.
It just doesn't. People find a way around
yes.
it. Right, or the economy slows down. Government spending cutbacks We absolutely, this is the first recession in 30 years for the government.
Yeah.
And it, in 30 years, a lot of inefficiencies can build up. I mean, many. And they're going after them, and that's great. But it's not going to work alone. The way to get out of this problem is to grow rapidly. And if we're right, thanks to these 5 innovation platforms, which involve 15 different technologies, including reusable rockets, for example, just to give an example of another technology. If we're right, these technologies are going to lead to an acceleration in real GDP growth globally. Yeah. And the last time we had multiple innovation platforms evolving at the same time was late 1800s, early 1900s. Telephone, electricity, internal combustion engine. Yeah. Real growth went from 0.6%, where it had been for 400 years, to 3% for the last 125 years. With these new technologies, these are 5, yes, not 3 platforms, and they involve many more technologies. We think during the next 5 years, real GDP growth globally will go into the 7% range. Most people think this is crazy, but the other side of that is potential deflation, which would take nominal, yes, GDP, yes, into that 5-6% yes, rate. Not much different from where it is right now, but very healthy and very positive for the equity markets from a valuation point of view.
In that incredibly hopeful note, yes, by looking to the past in order to have a glimpse of the future,
yes,
Cathie, thank you so much for this time. Looking forward to having this podcast version 2 again when you're next time here. We spoke of ideas about bringing these innovation and creativity dialogues here in Hong Kong. Yes. We're super looking forward to that.
Oh, well,
thank you,
It's been
Cathie.
My pleasure, and thank you. Thank you very much.